Especially when he pitched a 1-2-3. He pitched a 1-2-3 thriller opening day and it was on top of that. Oh yeah. Well, he's pretty awesome.
Okay, so the reason the camera is in here is because I have to go out of town tomorrow to a UT Systems event, and so I am taping this for my other class. So that's the only reason that's there. No big deal. If I have any questions before I start marching through the material. I'm going to go through chapter 12. The syllabus says 13 and 14 and then 12. For various reasons, I've decided to switch that, so we're going to go over 12 today. My guess is that you were busily working on your chapter 11 homework and didn't actually get to 12. Is that a fair evaluation?
Well, we were finishing chapter 11 on Mondays.
Right. So I'm guessing it's okay to jump into 12.
A few of us were wondering when, have y'all decided on an exam day yet, or a date for the final exam, I mean?
It's May 7th,
I think so.
and there is a specific time. It's either 8 to 10:45 or 11 until 1:45. So
In the morning?
I don't know which is specific, but I'll let you know. Okay, so let's talk a bit about chapter 12. And for those of you who are at all interested in investments, this is a good introduction to the quantitative aspect of investments, brief introduction to it.
So, you think we'll be able to get through 12 in one session?
Depends how many questions I get asked before I get started. So here we go with chapter 12, and what this is, and this is straight out of the text, figure 12.4. This is a very famous graph. Actually, the original graph didn't go as far, and I was stopped about here someplace by a couple of guys named Evanson and Sinkerfield, and they were academics, but since they've gone on to make lots of money. But they decided, hey, let's take a look at what the returns have been on large stocks, and that'd be like your S&P 500, small stocks, government bonds, corporate bonds, and treasury securities, and inflation. So the series is called SBBI, stocks, bonds, bills, and inflation. And so this is a very famous approach, and what we're seeing here is $1, that's what this says here, $1 in 1926, it says 25, but it's really end of 25, beginning of 26. That $1 invested in small company stocks would grow to be 26,000 is what that says. And that one, and you notice this graph is not like a regular graph because the difference between 10,000 and 100,000 is the same as the distance between 1 and 10. But this says 26,641, 4,676, 109.14, and 20.58 for treasury bills. And inflation, your dollar would have had to grow to $13 just to stay even. So that just kind of gives the long view. Now note, there's some pretty obvious trends over time, but there are ugly periods. So this is the beginning of the Depression. The stock market crashed, and you see how terrible it is. But then it went back up, and then it went back down, and finally got back on track. And you notice in some points, like right here, for example, the small company stocks took a big dip over this period, while the big company stocks were pretty much holding their own. So all this does is sort of set up what investments look like. You might wonder, what does this have to do with corporate finance? Well, we're going to try to get in there somehow rates of return, required rates of return. Is it warm in here? Okay. So this shows average returns over time. And you can see that small stocks have the highest rate of return over time, but what would you guess about their risk?
Very.
Higher risk. So pretty much the bottom line on this whole chapter is risk versus return. Higher risk you take, the higher return you would expect to get in the corporate world, investment world. So bills barely beat inflation, and long-term government bonds better still. You take a little bit more risk, you can get a higher rate of return with corporates, and then you go up to the ones that really have the highest possible returns among this group. Yeah.
So if inflation were to get higher than the rate of return on US government treasury bills, that is a very, very bad economic indicator.
Well, yeah, and I'm not sure if I mentioned in this class, I mentioned in one of the classes. Back in about 1980 or so, 81, 82, I had a one-year certificate of deposit that paid 12%. Inflation that year was 14%.
So you lost money.
Not only did I lose money, I had to pay tax on my 12%. So my 12%, let's just say for round numbers, dropped down to 9%, and with 14% inflation. So no, that was no damn good. I was not a happy camper, neither was anybody else. However, I'll show you something in a second that will give you a different angle on this. This is going to be hard to read even when I blow it up, but what this shows is the different years and what rates of return they had in those years. So you see 2008 was particularly hideous. That 1929 crash year was not as bad as 2008 was. Part of that is because in 1929 the market had gone up a good bit before it crashed. So it went down a lot in that period of time, but as a percentage it wasn't as high. Here we go with 29.
And you could also,
Go ahead.
I was just gonna say, you could also say that, like, crash at 29, but it really hit us in a year and started going back up to 34.
Yeah, well, not exact. That's not exactly what this says. So let's take a look at if we went back over here, we would see that it does correspond to 31, but only because no, you can't see that.
No.
It does correspond to about 31, but it didn't have to just because of that. It would have depended what happened in 30, for example. So let's go back to this. Now what this does is very simple math, and all it does is it starts with the basis as treasury bills. So we're going to be talking generally about a risk-free asset, and the treasury bill is going to be considered the risk-free asset. Now, is it really risk-free? Well, no. There's always the chance that the U.S. government could default. Not likely, but some people called for it a few years ago just to say, hey, let's not pay this back and we'll start from scratch. Bad idea. A bad idea to have deficit financing too, but bad idea to default on your debt. One reason it's not risk-free is because there is inflation, and we don't know what inflation is in advance. So we know exactly what this treasury bill rate will be if we buy a treasury bill, one-year treasury bill. What we don't know is what will be the real rate of return, because we don't know what inflation will be during that year. So we do have risk. But for our purposes, we're going to call this a risk-free asset. Everything else is off of this. So long-term government bonds, these are the same as from the previous table, earlier table. These are just this minus this, and this minus this, and so forth. So we're just seeing what the risk premiums are. And that's just, the risk premium is just that rate minus the risk-free rate. So this large stock rate minus the treasury bill rate is 8.6%. That's the risk premium. Now, when we say risk premium, we're really talking about the return that you can expect, not really expect, the return historically that has been received in excess of the risk-free rate for that asset class. The return that has been received in excess of the risk-free rate for that asset class. That's our risk premium. Premium just means how much return are we getting for taking on that risk. Okay, this one is really hard to see, but what it does is shows the frequency distribution of returns for each of these different investments. This is large stocks, and what you would sort of get out of this is, and you're knowledge of standard deviations, you can see that this one is kind of spread out, this one is even more spread out. And then we look down here at Treasury bills, and there's a little variation over time, but not much. It's pretty much dead on, fairly narrow range. Now this one shows, we'll go through a series of these, and again, they're in your book. This is large company stocks, and anytime we're above the line, that's a positive return, and how far above the line is how positive it was. And you can see that as crummy as it was here in 29, 30, and 31, and so forth, we had some big returns thereafter. So all is not always bad. But if you look at that, you can see that about 2/3 of the time, positive years. So stock market, 2/3 of the time, positive rates of return. Now that's for large stocks, and here's for small stocks. It doesn't look like as much, see if I can show them at the same time. It doesn't look like there's as much variability here, but this scale is much different than this scale. This one, you know, here's 40 here, and that looks about the distance for 100 on this one. So actually, the small stock is bouncing all over the place by comparison. But again, there aren't that many negative years relative to positive. Here it is for bonds and for Treasury bills. Now again, well, here we have in 1982, it looks like, Treasury bill rate close to 15%. And that's ridiculous, but that's what it was. Now, we think of bonds as being sort of boring, but this was about 1982, and this return is almost 40% on long-term bonds. Now, how does that happen? How would you think it would happen? Prices go up because, pardon?
Interest goes down.
Interest rates go down. Interest rates go down, price go up, interest rates go up, price goes down. So what happens? Well, you can see that the rate of return, required rate of return on Treasury bills, the risk-free rate was way up here, and then it started dropping precipitously. Well, what did that do to the required rate of return on bonds?
No.
It dropped.
No.
It dropped, and as a result, the prices of the bonds went up, so people ended up making a lot of money on bonds. And finally, here's inflation, and you see we don't have any negative inflation unless we go way far back, before my life even. No, I'm sad to say, it looks like there is one during my life. We'll pass that by. This graph, I think, is a nice one that just kind of lets you see all the numbers all at once for all the different investments, and you can just kind of look through that. Note there are two different sets of columns, 26 through 69, and then 70 through 2013. Now, I'm going to save this for a minute. Let's talk a bit about efficient markets. What is meant by an efficient market? So when you hear this term, efficient market, it doesn't mean the efficiency of the buying and selling process, and brokers don't make much money, but because the fees are very low these days. What they're talking about is information efficiency. Information efficiency. Now what that means is that information about companies, about stocks, gets to the market and goes through the market pretty quickly. And as soon as the information hits the market, that information is processed and it gets reflected in the price of the stock. So that a stock of a large company anyway is probably reasonably priced based on the information available. So it's kind of two things. One is that the stock prices will reflect the information, and the other thing is it'll do it quickly. So as soon as the information hits the market, there are enough smart people with computers that are on the floor of the exchange and whatever who can make buying and selling decisions immediately, and the prices immediately reflect that new information. So you find the cure to cancer, they're gonna find out about that quick, and the stock prices could go up now.
Especially if you're with a pharmaceutical company.
Well, yeah.
Or like when like there was a lot of speculation about Steve Jobs' health and Apple stocks took a hard hit as a result, especially when
Right,
it
and
died.
sometimes information is just noise, and it's hard to tell them.
Any examples of inefficient markets, like is there?
Okay, very good question. So if the market is generally efficient, what wouldn't be efficient? I'll go at it the other way. The market that should be most efficient are the big companies that people are watching closely. So in the automobile industry, for example, you'll have a lot of analysts whose whole job is to look at the automobile industry. And so you've got a whole bunch of people with the big mutual funds and wirehouses and so forth that are looking at these companies, and they've analyzed all the information that's available. So those big companies are likely to be pretty fairly priced. Where you're more likely to find things inefficiently priced would be in smaller companies and internationally. So if you look in other countries that don't have quite as active a securities market, which is pretty much every country, but smaller countries with less developed markets, that's when you may find some inefficiencies. So one could say then that your analytical skills are best put to use in those markets because you might be able to identify something that nobody else is identifying because nobody else is looking for it. So that's a good question.
So would you say that an efficient market is a transparent market, where there's an abundance of information given out by either the companies or analysts?
I'm going to talk around that. I'm going to talk around it. So ask that question in a minute. Just because the market is efficient doesn't mean that you can't make money. Stocks that are low risk will be stocks that aren't supposed to have a high rate of return because of the risk-return trade-off, and stocks with high risk should have high returns. So you can still identify a part of the market where you're comfortable, and that might be the low risk, low return part, and it might be the high risk, high return part. So it doesn't mean that everything is equal, it just means that it's fairly priced. Now, and this sort of addresses what you're talking about. There are three forms of the efficient market hypothesis. There's the strong form, the semi-strong form, and the weak form. I'm actually going to go at it from the opposite order that the book does. So this, no. Oh, no. Well,
Turn off two
I don't
seconds.
have the weak form, so forget this for a second. I'm going to give you the weak form. The weak form says that stock prices fully reflect the historical sequence of prices and trading volume. Stock prices fully reflect the historical sequence of prices and trading volume. Now, what does that mean? Well, if you think that you can look at the pattern of stock prices and say, aha, I see where this stock.
So stock prices fully reflect what?
The historical sequence of prices and trading volume. So if you were to see over time something that looked like this. So here's a stock and it goes like this and then it drops. And then it goes like this and then it drops. And then it goes like this and then it drops. Okay, do we see a pattern?
Yes.
Pretty obvious pattern. Okay, so you see this pattern and you're thinking, aha, I've seen this before. It's going to go up like this, and it's going to drop, and I'm going to buy it right down here so I can ride it all the way up, and then I'm going to sell it at the top. Question. Do you think you're the only one who sees this?
Yes.
No. There are lots of people with lots of money and lots of computer time and lots of reasons to try to identify this stuff that you're trying to identify. So beating them to the punch is not very easy. And here's kind of the logic of why it wouldn't be easy. What would happen if everybody has the same kind of computer you do, and they identified this also, and here we come, price is dropping, I'd sure like to catch it at the bottom, but if I wait too long, the price will zip up, so what am I gonna do?
You're gonna buy as soon as you feel like it's hit bottom.
Well, I might not wanna wait until it hits bottom, because I'm afraid that if I wait until it hits bottom, I will have missed the bottom. Does that make sense?
Put in a buy order at a low point?
I'm sorry?
Put in a buy order at a low point and wait till it hits?
Yeah, but you can't, the type of order that you're talking about is called a limit order, and you would specify a price. You can't say buy it at the bottom, because
No, I'm
they
sorry.
don't know what
yeah,
the bottom
that's
is
what I meant.
either.
Your bottom, your opinion on bottom.
You can specify what you think will be the bottom, but what happens if you think, and forget that one part for a second, what happens if you think, the bottom will be at this price? You put in orders. Well, what are other people doing? Other people are seeing the same pattern, they're thinking the same thing, and the concern is, what if I wait too long and it never gets to that price? If you put in a limit order that says buy at 50 and it never gets down to 50, you're screwed, because your buy order's not gonna be executed. So what's gonna happen is people are gonna jump in and they're gonna buy it here. And if that happens, other people are gonna maybe buy it here. So what's gonna happen to your pattern?
It's gonna start going back up early.
It will, but
Build a straight line eventually.
well, the point is, the pattern will be destroyed. Because everybody's seeing the same pattern, everybody's trying to act on the pattern, and because they foul up the pattern. So anyway, the weak form says historical sequence of prices and trading volume. Then the semi-strong form says that prices fully reflect all publicly available information. All publicly available information. Now, historical sequence of prices and trading volume, is that publicly available?
Of course it is.
Yep, publicly available information. Annual reports, 10K reports. Yep. Anything in the newspaper, anything in Barron's.
Credit information on that?
Any information that's publicly available, including the president of the company gave a talk to the New York Society of Securities Analysts. All that is publicly available information. And what the semi-strong form says is that all that information gets incorporated into the price very quickly. As soon as it hits the market acts on it. Okay? So that would be the semi-strong form. Now, the actual record for the semi-strong form and the strong form kind of mixed. For the semi-strong form, there's a lot to support it, especially among big companies. So among big companies, the semi-strong form, pretty good. Among small companies, probably not so good. And there are a few anomalies. An anomaly just means this doesn't fit the pattern that we're talking about here. So, semi-strong form, not okay, but not perfect. Strong form. Well, the problem with the strong form is the strong form includes all information. That means public and private information.
So perfect world scenario, basically.
How do you mean that?
That everything is known, everybody can act on every piece of information.
Well, it doesn't mean that everyone knows everything, and that's part of the problem. Some people know more than others, and it's not because they're smart, it's because they are where they are. So if you work for a company and you know what the earnings announcement is gonna be, it's not a guess, you know what it's gonna be. If you buy stock based on that or sell stock based on that, that's trading on inside information, and that's against the law. So how are we gonna test this strong form efficiency? Go around and ask everybody, hey, did you trade illegally? Tell us how you did on that trade. You're not gonna get a whole lot of people responding to that survey. So it's very difficult to test the strong form. Now, they actually do look at insiders. And it's very hard to tell if they're trading on insider information, but they may have some pattern to their purchases. But strong form, very hard to say that that one is correct. So that's about as far as it goes. Now, we're going to pivot. Any question on any of that stuff? Well, not that it exists. It's all it's saying is do current stock prices for the weak form reflect all information about the historical secrets of prices and trade volume? Can we say that that information is quickly reflected in stock prices? And the answer, yes, that there's pretty clear evidence that that's the case. The semi-strong form, is it pretty clear that current stock prices fully reflect all publicly available information? For big stocks, we can say, yeah, it's pretty good. Now, is the strong form correct? That current stock prices reflect all information? And we can't really say that. It's very, very hard to test, and even when you do, it's kind of uncertain. Okay. Now we're going back to something that you had in another class. What class did you have statistics in? It's just that. How many of you took statistics here?
I think everybody does that.
Taking statistics, okay. So we're not going to do too much in statistics here, except for standard deviation. So that's something you need to know. Now, with standard deviation, the normal distribution, your basic old bell curve, very important piece of information here, between 1 and -1 standard deviation from the mean and +1 standard deviation from the mean. What percentage of the cases fall in that range?
68%.
It's about 68%. And between plus or minus 2 standard deviations, about 95, and 3 standard deviations, about 99. 3 important numbers to remember. So 68, 95, 99. Okay, now I'm gonna hand something out, and we're gonna go over some stuff that has to do with returns and risk.
Will this be found online, because online is too, people will watch the video?
Sorry?
Will this be found online when people will watch the video?
Yeah, for all those, like, are you one who goes to the Cowboys game and only watch the big screen at the game and not the?
It's a good screen.
It's kind of hard, you do get distracted.
Unless you're sitting on the sideline, you really aren't getting that great a seat in place.
I hear you.
So it's whoever does Brian Sandstrom.
Does Brad, you're not my favorite guy. Is this the,
He doesn't like you either, so that's okay.
yeah. Well, he doesn't like a friend of mine. One of my classmates, a guy named Billy Hines, is the the general manager of North Park.
Oh,
And you know, they kicked him out of North Park for, he went until his pants up.
He wasn't on my team. I ain't better.
Okay, so you have this, and now let's go through what this is talking about. So forget that it says modern portfolio theory building blocks, let's just talk about it as some statistics stuff that maybe you had or maybe you would like to have, or maybe you wish you didn't have to have, but here it is. Go ahead and pull out your calculator while you're at it. Okay, now, look up here for a second, everybody look up here. See this 2 right here? Scratch out that 2. Now, we're going to talk about ex ante and ex post. Ex ante means before the fact, and ex post means after the fact. Sort of like an antebellum home, if you've ever heard of that term, that's a house that was built before the Civil War. Bellum being the word for war. A postscript is at the end of the letter. So this is ex ante and ex post. This is ex ante, we're looking before the fact. And this is actually the one that is most appropriate for corporate finance, because we do look from before